Hey, this is Hutch with bankingtruths.com, and today we're going to revisit the age-old debate between direct versus non-direct recognition, what type of loan type you want for your IBC whole life policy. Now, we're rebooting this video from 2020, but our story hasn't changed. However, since we're in a vastly different interest rate environment, we have new evidence validating our stance that we've had for well over a decade now, that you actually want direct recognition versus the vast majority of IBC agents are saying you have to have non-direct recognition. You must, which is kind of curious because every single example in Nelson Nash's book was direct recognition. Now, to be fair, there are other agents and teams out there that are saying, it doesn't matter. It's 6 of one, half a dozen of the other. And they're probably right. But again, this new evidence is validating our point that the safeguard, the backstop of direct recognition is very, very valuable. So we feel validated today. And some of those agents that insisted, gave you the opinion, gave you the anecdotes of non-direct and insisted you take it without stress testing the facts may just owe you an apology. So without further ado, let's get into it. So let's first discuss what it even means, direct versus non-direct recognition. It's kind of one of those things like secular, non-secular, fiction, non-fiction. I remember when I was a kid, that was very, very confusing to me. You think non-fiction, not true, but you actually have to replace the word fiction with false. And then fiction equals false, non-fiction equals not false or true. Non-direct is the same thing. We're going to replace the word direct with effect. So direct recognition means there will be a direct effect on your dividend only on the cash value that you're borrowing against. The cash value that you're not borrowing against, there won't be any effect. And with non-direct recognition, it doesn't matter how much cash value you have. There will be no effect on your dividend, whether you're borrowing or not. So hopefully that clears that up. And to the untrained eye, non-direct recognition seems like the obvious choice. Most people come from a place, a mentality of, you know what, Hutch, I know you're saying I can get these cash value lines of credits where most of history they were cheaper than borrowing against my policy, whether it was direct or non-direct recognition. I know you're saying you can do this comprehensive, holistic 4D banking thing where you use other account types and loan options in your world and you have a matrix of assets, not just life insurance. I just want to know that this IBC policy, that I can always borrow against my policy without an effect. I want to have this non-direct recognition in my back pocket. And this comes from the erroneous assumption that the direct effect on your dividend with direct recognition will always be negative. And the reason people assume this erroneously was the fact that for the last decade and a half, we've been in a low interest rate environment. And so the loan rate has been below the dividend rate. And when that happens with direct recognition, when the direct recognition company is going to give you a loan, a policy loan, cheaper than what the dividend is paying, then they're going to affect your dividend. They're going to tamp down that dividend on loan money. Their only other alternative would be to do what non-direct recognition companies do, where they essentially have all policy holders subsidize your cheap money loan. And let's be clear, there's never been a huge disconnect. You're never getting super below market rates. In fact, our chart here shows the policy loan of one of the biggest non-direct recognition companies, Mass Mutual, compared to prime minus a half a point, which is what most lines of credit, like kind of the entry level pricing you can get for the lines of credits. You can actually get prime minus 1, prime minus 1.25 if you're a big policy holder. But you'll see for most of the last decade and a half, most of the time, you still wouldn't even want to use the non-direct recognition loan. Sure, they're not affecting your dividend, but neither is an outside line of credit company. They're not calling the company going, hey, ooh, he's borrowing, punish his dividend, right? But now we're getting like a point to 2 points of arbitrage below money rates. And so the safeguard, if you will, of non-direct recognition in a low interest rate environment was practically non-existent. Now, ooh, how the turntables have turned. You can see the spike over here when we had an inverted yield curve. Short-term rates went higher and loan rates went higher than dividend rates. Well, now all of a sudden, what happens with non-direct recognition loans is when your loan rate is above the dividend rate, yes, there's no effect to your dividend, but that may not be a good thing in this environment. In fact, way back here in the 80s with Mass Mutual, there was a period of a disconnect where loan rates have spiked well above dividend rates. And what's interesting, so like there's going to be no subsidy there versus if that was a direct recognition loan rate, they would actually pull your dividend up because now all of a sudden you're paying the company loan interest. Well, it's not fair for them to take your above market loan and sprinkle that between all policyholders. So they essentially raise your dividend in that environment. But let's just be clear, this period back in the 80s where Mass Mutual's non-direct recognition loan was above the dividend rate, it's non-direct recognition. So there's no effect. There's no lifting up of the dividend. You have money in cash value. You can withdraw it, right? You lose your PUAs. You can withdraw it to not pay the loan. But if you do want to borrow against it, keep your money compounded, you're going to be inverted. You're going to be negative now for a few years. And we're seeing examples of this today, not so with Mass Mutual, but with another very popular non-direct recognition company where they're a good company. They're a smaller company, Lafayette Life. I hope they do the right thing by policyholders. But as of September 2024, and this is being recorded in January 2025, their loan rate jumped from 5. They were giving away cheap money, below market loans. It was being subsidized by all policyholders. I don't know what the decision making was behind this, but I assume it has something to do with the fact that it's not really fair to all the policyholders to subsidize these 5% cheap money loans when the dividend was above 5. And so now it's time to pay the piper. So they're going to charge anybody who's borrowing 7. And so people who, advisors, agents who told you, get all your money working in there, do the big dump in rider that is unique to Lafayette and get your money working for you and just borrow against it if you need it. Well, again, now you have the situation where the money's trapped in there. You can withdraw it, kind of lose all your PUAs, or you can borrow at 7 where the dividend's 5.75 and be inverted for a while. And again, if this was, there is no effect. It says right there on their company language that this does not affect your dividend. Paying the higher above market dividend rate does not pull it up. And I know some of you are thinking, but wait a second, when I read Nelson's book, like my policy was better. The policies in there were better when you borrowed than if you didn't borrow. That's because the examples he showed were direct recognition. And with direct recognition, that actually happens where you're borrowing against direct recognition and you're paying an above market loan rate. They are going to lift up your dividend above what they would pay non-borrowers because you're the one that's paying that higher dividend rate. And my example that I have to show you is from one of my oldest policies, one of my smallest policies. It was on my wife. I actually ran this example in 2020 for my first video where I showed a borrow situation and a non-borrow situation and just showing the age-old example of like buying a car, like borrowing $50,000 to buy a car. That's kind of what a car costs these days, even just like a normal car. And what you can see is that I do end up with a bigger cash value balance when I'm borrowing compared to not borrowing, but I actually had to subsidize some of that because my old Guardian policies have an 8% locked direct recognition loan. And at the time, Guardian's dividend was 5.75. And so when I'm paying for that 8% loan, they are lifting up my dividend on loan money. And that's why at the end of the study period, you can see where I end up with considerably more cash value than if I hadn't borrowed. So I'm technically not paying my interest to myself, but I kind of am, but only with direct recognition, like all the Guardian policies that were shown in Nelson's book. You know what? I always want to be able to protect my cost to borrow. I always want to know that I can protect that because if I'm borrowing against my life insurance policy, certainly for investments, I'm making my yield over there. So I just want to know that my money's still compounding in the policy, but I do want to control that cost to borrow. And if you're borrowing for expenses, same thing. You can always go out and shop for cheap money loans, just like we saw with that chart before. There's only been like a handful of times in history, and they're all short-lived, where these inverted yield curves happen, these short-term spikes in rates, and then things come back to earth, and I'm able to find cheaper money than what my policy can offer anyway. Okay, let's take a look at the numbers with today's example. We have the benefit of the fact that we're in January 2025. A lot of these loan rates just reset, and we proactively compiled data at the end of 2024, knowing we were going to do this comparison. And so now we're going to compare the top two non-direct recognition companies, Lafayette Life with the highest early cash value, Mass Mutual, pretty good, higher earlier cash value than Penn, higher long-term performance than Lafayette, and then Penn with the best long-term performance, obviously being direct recognition rather. All of these examples are male, age 47. Second best rating, the preferred. They all have different names, but the second preferred, not preferred best. And we're doing a 7-pay with maximum PUAs that the company will allow with using the term rider and everything else. So with that, I will just say, now that we've looked at just the grow only, not just the loans, we decided just to make this a 2-horse race because of the fact that Lafayette raised their loan rate to 7 and the dividend's only 5.75. That's a non-starter for us. They're a good company. I hope they choose to do the right thing. I think they probably had to because they were giving away these 5% loans for so long, and they have to kind of equalize things for the non-borrowers, since non-direct recognition does not give you a way to treat borrowers and non-borrowers fairly, and that's really what direct recognition does. It just treats everybody fairly. Also, something that's concerning when we dug into the language is the fact that there is a cap, because most non-direct recognition carriers don't have a cap like we saw with Mass Mutual. The loan rate got it all the way into the 13s, even though dividend rates were 11. And that's how they're able to treat all policyholders fairly, by adjusting the loan rate. Well, Lafayette has a cap of 8%, which is probably an old provision thinking, oh, we'll never go above that. And who knows, maybe we won't. But what concerns me is long-term, if we get back to that 11, 12, 13% loan rate, the fact that they are on a guaranteed basis offering everybody loans at 8, they're essentially going to have to kind of direct recognition everybody, even the non-borrowers. They're going to have to reduce that dividend to make up for the loans leaving at 8, when maybe their dividend should be 10, 11, 12, 13, whatever it is. If they're giving away loans at 8, they're going to have to actually make that adjustment, but to all policyholders, since they're non-direct recognition. So at this moment, it's a non-starter. And again, I hope that they adjust things to be able to do the right thing for all clients. Okay, so back to our 2-horse race. We took our best non-direct recognition versus best direct recognition. We put the same loans and payback schedules. The way it kind of looks is a little bit wonky because it kind of steps on premiums over here and it's unbundled over here. But we equalize things to be fair. And then we're going to see how things perform in different interest rate environments. All right, so we're going to look at a couple different time frames. Let's start with our guy at age 66. He's done paying premium, he's done borrowing and paying back and building, and he's ready to reverse engineer his policy and take policy loans for retirement he's not planning to take back. So just before he does, with Penn, he gets to 673 and change, 1.1 of death benefit and change. He's 671 and less death benefit because that's just how Mass's policy is built. Now, to clarify, the loan rate on the Mass policy is 5.33. For Penn right now at January 2025, it's 5.3, which is below their dividend rate of 6. Mass is 6.4, and so you would think that Mass would just be crushing, but it's not, because the dividend, you can't compare one company's dividend to another. It's how they credit it, it's when they credit it, it's the guaranteed growth, which has nothing to do with dividend. I digress. Now, if we scroll down to how long they can take income, we actually equalize the income as far as these $42,000 loans coming out for multiple decades, and you can see the Penn gets cut off, and there's an interesting little footnote here because they have a rider called the Overloan Protection Rider, which is awesome. Most IUL companies have it. I don't know why more whole life companies don't. It's really only Penn and One America, which from a performance standpoint is not even in the ballpark of any of these companies we talked about. But with Penn's Overloan Protection Rider, they basically say, look, you got $80,000 of cash value left. We're not going to let you touch it because it's supporting $349,000 of death benefit. And then we're just going to preserve a certain amount of death benefit. You can see it kind of, it goes away, it erodes a little bit each year. That's because the loan is still accruing against it, but it's not going to blow up. That's the important thing. Thankfully with Mass, the Mass doesn't blow up either. But the reason why you can't touch the cash is because premiums will come back. You can see at age 95, you have to actually start paying premiums to keep it going. And I realize most of you are thinking, okay, that's fine. I'm not going to die then, so I can just float it. But remember, since Mass is non-direct recognition, the only way they can equalize, treat policyholders fairly, is by raising their non-direct recognition loan for borrowers. And the loan just went up. Like in December, it's 5.1. Now it's 5.33. So it's kind of a noisy indicator. So what we did is we wanted to equalize. What if it's a percent higher? Let's see what happens to Mass. Let's see what happens to Penn. This is very interesting. With Mass, you can see at 6.33, the income, you don't get to take income till age 89. Your income stops at age 85, and you don't get the full 42. You get half of that. You get 21. With Penn, you can see that you continue to get income for a long time, almost the full amount for the full period. Furthermore, because of that overloan protection rider, you are protected against it blowing up. And so not only do you not get the full income at age 85, 86, 87, 89, but you actually see premiums come back right away. You're done with income, and to keep the policy going, you have to keep paying premiums. So we didn't pick these numbers, this 24, 221, 26, 235. The system defaults to saying you got to pay this or your policy's going to blow up. But let's just go back to why is Penn's income actually lasting so much longer? Is because direct recognition treats policyholders fairly. So when you raise Penn's loan rate to 6.33 instead of 5.33, well, before they were kind of squashing your dividend a little bit, and it's still kept up with Mass. Now they're lifting your dividend up because the dividend is 6 right now, but we're showing in this illustration, and we're showing a 6.33 loan rate. So on the borrowed money, they're actually pulling up. You're not paying yourself back interest, but they are directly subsidizing your policy because you're paying, in their mind, an above market rate loan, because they're paying all other policyholders 6. So they're not going to take the extra interest you pay and disseminate it amongst all the other policyholders like non-direct recognition does, like Mass would have to do in this example. I don't know about you. You might be comfortable juggling loans right now. I know I am. I don't know how comfortable I'm going to be with it at 87. So I actually like the protection of direct recognition coupled with the overloan protection rider. Well, let's look what happens when it goes up another percent. What happens when this loan, where Mass's dividend is 6.4, Penn's dividend is 6, what happens if we raise both loan rates to 7.33? Because we saw in the past with Mass Mutual, it could be disconnected by a pretty wide margin. Well, what happens? Your income you don't get a partial income at age 85. Now you get a partial income at age 81. Instead of the 42, you get 27. Penn's income is a lot more stable, right? You have a lot more stability. Why? Well, it's because of that direct recognition. If you're going to pay a 733 loan rate on all that borrowed money, the company is going to directly credit you a lot of the interest that you're paying because it's direct recognition, but only direct recognition. Look at the premiums. Like instead of having a $24,000 premium due at age 86, you have a $30,000 premium at age 82, right? And they keep going and they keep getting bigger just to sustain the policy. So will I think that Mass gets this disconnected? Probably not. No. But we're seeing that it's already happening with another non-direct recognition carrier, Lafayette Life, right now. So it can happen. Like that's a pretty big disconnect to go from 5 in August to September be 7 and then carry that. And you have no control over that. And so to me, direct recognition is the ultimate backstop. I think the other thing that plays into it is Nelson Nash had a great rant. It's like multiple chapters long. I've been rereading the original book, Becoming Your Own Banker, the Infinite Banking Concept, having a deeper appreciation for really the conceptual knowledge of IBC, but also this concept of the honest banker. Because he talks about like, hey, if you're going to borrow from your policy, you got to pay it back. And if not, if you own a grocery store and you let your wife come in and go out the back door, you're a thief and like the whole thing's going to blow up. Well, isn't that true with non-direct recognition? Like the way that non-direct recognition is being sold, the way it's being pitched shows up for me like a dishonest banker. It's like you're getting over on the insurance company, which is also ironic to me because it's like saying non-direct recognition. It's this great little hack that I found where you can just siphon non-stop positive arbitrage from these companies, which we already know now is not true with what happened with Lafayette. But that's how it's being pitched. That's how it was pitched all last decade. Like, yeah, you're going to siphon this arbitrage from this company. Well, that's a dishonest banker. And the dishonest salesmen, the dishonest agents, they're pitching that, but then they're also saying out of the other side of their mouth, and by the way, this is one of the strongest companies in the world. Both of these things cannot be true. This is mutually exclusive, right? The company can't be one of the strongest in the world and let people go out the back door of their grocery store and be a dishonest banker. So again, I strongly suggest, whether you have old policies, whether you're looking at new policies, get a second opinion. And what I can tell you is if you come to us, not only are you going to get a second opinion, but probably you're going to get first facts. We're going to prioritize factual information. We're going to prioritize critical thinking. We're going to prioritize stress testing. We're going to prioritize customization. And that's how we operate at Banking Truths. That's why I named my company that well over a decade ago. What you'll see when you look into our old content, we have the most robust content libraries. We've been saying the same thing all along. Here we are in 2025. Our story hasn't changed. We just keep bringing the critical thinking and the factual stuff that backs it, rather than these anecdotes and feelings. Well, I feel better with non-direct recognition in my back pocket. Feelings, nothing more than feelings. I feel better with direct recognition in my back pocket. And you can see why if you want to rewatch what I just showed you, because I realized that was a lot. At any rate, hope you enjoyed this video, and we look forward to talking to you soon if you're ready to have a deep dive into your situation. Talk to you then.